My name is Jeannie Drake, and I am an independent member of the Private Equity Reporting Group.
I'm Nick Land, and I'm one of the independent members of the Private Equity Reporting Group, and I also chair it. The Walker Guidelines was developed because in the early part of the 2000s, there was a considerable disquiet, both in the media and through politicians, about the private equity industry, a feeling that it all happened behind closed doors. And the industry was under considerable pressure to improve its transparency. The private equity-owned companies that are in the scope of PERG are the large ones, measured by the size of their revenue and by the number of people they employ in the UK, for instance, over 1,000.
If companies choose not to comply, then we will publish the fact that they don't comply, so they will be named. But bottom line, we can't force compliance, but we do get a high level of compliance. The industry enhances the general public and stakeholders' knowledge of the industry and enhances the understanding of what the industry does and private equity firms do, and that's really important. The second one is that more and more governments are raising the bar on reporting requirements on companies. This is going to evolve, it's not going to go back and be less reporting. So it sets a framework for the industry, which if they work within, keeps them moving in line with the general movement in the rising reporting requirements that governments increasingly are expecting of both public and private companies. The third one is that if the level of transparency and disclosures is rising, then by effect, the standard of governance in these companies rises, and that's a good thing.
Walker Company disclosures are pretty similar to listed companies. The benchmark that we have is against the FTSE 250 public companies. So they need to be operating, disclosing, being transparent at a pretty high level. And generally, they meet that standard.
The other area is we commission PwC to do a comparison of the disclosures and reporting against the guidelines of the population of private equity firms we are looking at with the FTSE 250 companies.
Yeah, the guidelines have developed and evolved fairly considerably since 2007. I mean, in 2014, we had a major overhaul, which sort of recognized significant changes for public companies around the strategic report, increased transparency around risk and those sorts of things. But in a way, the guidelines tend to evolve each year, not that necessarily the description of the guidelines changes, but the benchmark is moving up all the time. Some of the important reporting requirements that have happened since 2007, in particular the introduction of the concept of a strategic report, really the front end of it, putting much more information in the front end of annual reports around the strategy, the business plans, the KPIs, both financial and non-financial, and the risks, the principal risks that a company is dealing with and grappling with. So there's been some big changes there. I think the major area that PERG is focusing on at the moment is around ESG and is around, in particular, climate, energy, etc. There is a requirement, increasing requirement now for companies not just to talk about what they're doing, but to demonstrate through data and statistics what they're achieving. And we're seeing in the UK, Europe and the USA, regulators beginning to enforce much more the accuracy of the information that needs to be disclosed and whether it's accurate or not.
That doesn't mean there isn't scope for further improvement. There is, particularly in environmental issues, but there has definitely been improvement, but that's not being complacent and saying, well, that box is ticked. There is definitely room for improvement.
We encourage companies to move in a number of ways. I mean, first, we publish our annual report, which is pretty detailed and does call out good and bad practice. PwC published their good practice guidelines, which again are very detailed and very helpful, give really good examples. BVCA themselves spend a lot of time in liaising with private equity houses and with portfolio companies, helping and encouraging them to improve their disclosures. So, you know, there's quite a lot of sort of pushing and shoving going on just to encourage people, you know, to raise their game to the next stage.